So welcome again to Ask an Expert, Businesses in Transition and How to Stay in Control. Just to introduce myself, my name is Carol Benedetti and I work with the Aurelia Community Development Corporation. I'm the project coordinator for BizLink, which is a program that we've developed to address exactly what we're talking about today, which is business transition. BizLink is a program that connects buyers and sellers to facilitate successful business transitions in partnership with Nottawasaga Community Futures, North Simcoe Community Development Corporation, and the South Georgian Bay Center for Business. Key services that we offer include confidentiality and anonymity, connection suggestions based on each individual buyer and seller, referrals to local professional resources such as business valuators, tax planners, accountants, lawyers, and real estate agents, contact with immigration specialists to promote businesses to international buyers, customized sales sheets to promote businesses through local networks, access to financing and coaching, workshops such as this one on related topics such as bookkeeping and business valuation, and subsidized access to an independent online portal, which is successionmatching.com, which contains a broad database of buyers and sellers and a variety of other resources such as articles and webinars. So again, thank you to the committee that organizes these webinars and our partners. The Planning Committee and the Ask an Expert series is led by the County of Simcoe. Thanks to their leadership, we were able to bring organizations throughout the county some excellent content as you navigate the current environment. I would encourage you to keep an eye out for future webinars, including the next event on June the 9th on COVID's impact on women in business. The CDC, in partnership with RTO7, is also offering a cybersecurity training webinar. It's not part of the Ask an Expert series, but hopefully it's something that you might be interested in. And that's going to be on May 27th from 12 to 1, and you can visit our website to register for that. Also, I would like to thank our regional partners who have assisted with these webinars. Of course, that includes the County of Simcoe, but also the Small Business Center of Barrie, Simcoe County and Aurelia, South Georgian Bay Small Business Enterprise Center, Aurelia Area CDC, Nottawasaga Futures, North Simcoe Community Futures Development Corporation, and the Center for Business and Economic Development. In regards to Q&A, prior to today, several of you submitted questions, which was great. And we have provided those to our experts so that they could see the kinds of things that you were interested in particular in learning about. But if you have questions during any of the presentations, please feel free to put them in the chat, and we will be doing all our Q&A at the end of the event. We'll be monitoring the chat throughout, but we will do all the Q&A at the end. So I feel very fortunate to have the opportunity to facilitate today's session on such an important topic, particularly with all the added pressures that everyone is feeling these days at home and at work. We have an excellent panel of experts with us today to share businesses in transition and how to stay in control. And I will introduce them all in the order that they're going to speak. And then at the end of that, you won't have to hear much more from me for the rest of the webinar. Our presenters, beginning with Tim Timpano. He is an experienced corporate and commercial and labor and employment lawyer at Downey, Tarnowski, Lazaline, and Timpano Law in Aurelia, and is designated as a specialist in corporate and commercial law. Tim's practice includes incorporating and organizing businesses, assisting parties with business purchase sale transactions, corporate reorganization, and succession planning, reviewing franchise documents, drafting shareholder and partnership agreements, and other similar matters. He also has experience regarding employment contracts, restructuring, wrongful dismissal, employment standards, collective bargaining, and grievance arbitration. Our second presenter is David Holmes. David is a chartered business professional accountant, chartered business valuator, and certified in financial forensics with over 20 years of valuation, finance, and accounting experience, working with organizations that have ranged from large publicly listed companies to smaller owner-managed entities. David is also the past economic advisor to the Canadian Institute of Chartered Business Valuators and York University, where he was responsible for overseeing the CICBV's program of studies. David is a partner at Rumley Holmes LLP, a professional services firm with over 20 professionals where he advises business owners on valuations, the purchase and sale of businesses, and tax minimization strategies. And lastly, we have Brenda Wood, who is Brenda and Robin. Brenda is a partner at the restructuring practice of Farber. With over 29 years of insolvency experience, her practice focuses on the administration of consumer proposals, personal bankruptcies, small business restructurings, receiverships, and corporate bankruptcies. Robin White, her colleague, is a managing director with the restructuring practice of Farber. Her practice focuses on restructuring solutions and financial advisory services for small and medium-sized businesses. So I want to thank our experts again for coming, and I'm just going to lead it off with Tim.
Great, thanks, Carol. Am I live? You can hear me okay? Yeah, fantastic. Yeah, so thanks for the introduction. The Ask an Expert series always, I find it rather daunting that I'm considered an expert, but I'll do my best to share with you today. And I'd just like to thank the County of Simcoe and the other program sponsors for putting this together, and also to the Orillia Area CDC for hosting. Great information, obviously, for the participants, and I look forward to sharing what I have and learning from my fellow panelists. It's going to be a good day. I think the idea is to try to get through the presentation in about 15 minutes. I'll do my best, 20 max, and I think we'll all get through our presentations, and the Q&A will be at the end. We'll be able to get to everybody's specific questions as we go. I will make my contact information available at the end of my presentation. So if anybody has any follow-up questions that we don't get to today, feel free to contact me directly by email or phone. I'm happy to answer any questions that you might have. And I'm going to go through things rather quickly as we go. So the slides that I have today will be made available to everybody, so you don't have to worry about writing things down as you go. The slides will be available, okay? So I think that's really enough of an intro. The topic for today is about businesses in transition and staying in control. And from my perspective, it's really about the first two topics, right? It's about selling your business and closing your business. So that's really what I'm going to be focused on. And then obviously it's through my lens, right? I'm a lawyer, so I see things from a slightly different perspective, and that's the perspective with which I'm going to share with you today. The focus of the presentation really is going to be a lot on selling the business. And I think I'm just going to get my screen up here, start my slides. But for the purpose of today, if you own a business, there we go. We're up, right? Looks good. I'd like to focus a little bit more on selling the business, right? If you own a business and you've worked for a number of years, hopefully there's significant value in your business and you deserve to get something out of that. So I think selling the business likely is the first option for many business owners. And to be fair, most of the work that you have to do in terms of getting a business ready for sale is also the groundwork that you need to do when you're looking at closing your business. So for today, most of my presentation is going to be focused on selling the business, and then we'll cover off steps for closing the business towards the end. So in terms of selling the business, I just literally like to break it down into three main parts. And what I'm going to do today is I'm going to walk everybody through kind of a basic overview, again, of the legal process that's involved. Don't be overwhelmed by this. I'll go through a lot of the stuff fairly quickly, but my intention today was just to give everybody a really good overview of the process, right? Understand the process and understand what's involved. And so there's no surprises down the road when you're in the situation where you're looking at either selling or closing your business. So in terms of selling the business, really we broke it down into three main parts, about preparing your business for the sale, and then documenting the sale, and then dealing with post-closing issues that come up after the sale, right? So pretty basic stuff. We're going to break that down into three, and we'll start off with preparing the business. So certainly preparing for the business, preparing for it to sell is probably the most work. And the first part of that is about gathering and summarizing all of the info that's relevant to your business. There's a lot that goes into planning to sell the business. And you want to be as efficient as possible when you start meeting with your advisors. So if you don't have any kind of a document that helps to organize your business to get it ready for sale, reach out to your advisors. Most advisors will have some kind of a standard checklist. I have one here. If you're interested, you can send me an email. I'm happy to share that with you. But it'll really give you a good idea of everything you have to gather and get together and get summarized, so that when you meet with members of your team, whether it's Robin or Brenda, whether it's David or myself, you go in prepared and you can get good, efficient advice, right? Time is money. So the less time that you spend on me, the better, right? So gathering all the information together is extremely important. And then the second thing is meet with your team early. I don't think I can stress that enough. You certainly don't want to get too far down that road and then realize later that you should have done something differently from the outset. So, who's your team? Well, certainly, your accountant, your lawyer, your financial advisor, but perhaps your banker, if you've got financing in place, your lender, trustee, if you're in a situation that requires a business trustee. Start getting input as early as you can in the process. And everybody has a slightly different perspective. And I think I want to make this comment as well. It really doesn't matter where you start, right? We deal with each other on a very regular basis on behalf of mutual clients. And I think we all do a really good job of staying in our lanes, right? So if you come and see me and we're talking about a potential sale, there's a point where I'm going to say, okay, so here's all the stuff that you and I can talk about, but now it's time, you got to go talk to your accountant, right? Now it's time that you got to go talk to David because he can help you with a business valuation. So it really doesn't matter who you start with. It just matters that you start. And maybe it starts when you're in front of your accountant, preparing for your annual financial statements or your tax returns, or maybe you had a different matter, you were talking to your lawyer and you start discussing a potential sale of your business. Doesn't really matter. Get with your team, get with them early, and start planning well in advance, okay? Certainly when you meet with your team, you need to talk about deadlines, right? If you're up against a deadline, that's going to be extremely important. If you have some idea of a timeline, that's also extremely important. I think in David's presentation, he might talk a little bit about how you might qualify for a small business capital gains exemption if you're looking at selling the shares of your business. In order to make sure that you qualify for that, it could require some a number of items before you get to the actual sale of your business, some of which might be 2 years in advance. So if you have the luxury of time, then certainly start discussing timelines and again, getting with your team as soon as you possibly can. So once you get to that point, you probably talk to your advisors a little bit about a sale of shares versus a sale of assets. There are differences, could be substantial differences in terms of tax issues and legal issues. I'm not really going to spend time on that right now. We'll talk about it a little bit later. But early in the process, you want to get your head around the differences and how you want to structure your business for a potential sale of either your shares or your assets. Of course, selling your shares implies that you're incorporated. Not everybody here is an incorporated business. But if I talk about selling shares, obviously, I'm talking about businesses that are incorporated. Okay. So after you've gotten to that point, now it's time to normalize your business, right? This is an accountant's world largely. I'm sure David will have some comments about this as well, but for businesses that have been run, mom and pop type business, closely held businesses, sole proprietors, it's not uncommon that maybe the business leases a vehicle for the business owner, and that's really, your private personal vehicle. And so you might have some assets that are held by the company, for example, or by the business that aren't necessarily business assets. So before you look at anything, you want to start identifying some of those assets and transferring them out of the business in order to make sure that everything is in order when it comes time to sell. The other thing about normalizing is are your wages and salaries, are they market wages and market salaries? In other words, if you had somebody doing your job, would you be paying them the same, right? Would they get paid the same as you're getting? I've had many clients come into my office and say, well, my business does really well. And we go through the financial statements and I say, well, there's nothing here for salaries. And they say, well, we just kind of take what's left at the end of the day. And that's fine. But if you had to pay for somebody to do your job, what would that look like, right? So how profitable is the business when you start to put in things like proper wages and salaries for your employees that might not be already captured, okay? So normalizing obviously is important. Cleansing the business, I just alluded to that previously. You might have some assets in the business that aren't active business assets. And if they're not active business assets, then you probably want to get them out of your company. Mostly I'm talking about a corporation. And you want to do that potentially, 2 years prior to the sale to make sure at the time that you sell the shares, you're going to qualify for your lifetime capital gains exemption with the sale of your shares. Again, I don't want to get into too much detail, but if you've got questions about that, I know your accountant can answer, David can answer, I can answer today if you've got questions about that. So just the other thing about normalizing and cleansing is there might be some things that you need to do well in advance of closing to get it ready. Might require a brief restructuring of the business or a small restructuring. You might have an operating company and a holding company. And in order to get it ready for sale, you might want to amalgamate those two. There are other things that you might want to consider. So again, get with your team early, get the business ready for sale. It involves normalizing and cleansing the business. I'm sure David will talk about this. Make sure your financial statements have been prepared and are ready to go. Make sure you've got all your tax returns done and up to date. If you've got your annual financials and they were some time ago, but you're not ready for your next set of annual financial statements, you might talk about quarterly statements or monthly statements. You want to get everything ready so that when you have a buyer lined up, it tells a story, right? You're already ready to go. You're nice and clean. You got your act together, and you can share whatever information you're required to share with them. So get that in order. This is an important one. I can't stress this enough. Before you get married to a number, and before you decide how much your business is worth, and you've got your retirement plans ready, make sure you get your business properly valued. And I know David does business valuations. I hope he speaks to that today as well. I've had clients come in and have everything all ready to go, only to realize that the business isn't near worth what they thought it was. And that can really put a crimp on things. So don't get married to any numbers until you get a proper business valuation done. You really need to get a sense of the value of your business before you go too far down that path. If you can talk to your accountant about getting a sense of the value, but I would probably tell you a proper business valuation is most important. And that's especially true if you're looking at selling the business potentially to maybe an employee of the business, or even if it's a succession plan with a transfer of the business to your children. Having a valuation that you can rely on takes a little bit of the emotion out of it, and everybody can just kind of point to the numbers that are provided in the valuation. So get a valuation done and get it done before you have any numbers in your head about what your business is worth. All right, if you're incorporated, get your Minutebook up to date. It should be up to date every year. If it's not, get it up to date. I got a long story about why that's important. I won't share it with you today, but get your business in order, get your Minutebook up to date so that when you're looking at selling the shares of your business, there's no concern at all about the Minutebook, okay? It's got to be accurate, and it's got to be complete, and it's got to be up to date. So do that. Probably the most important step in all of this, or maybe almost the most important step, is you've got to review all of your contracts and your obligations, okay? Your lease, for example, if you lease the premises that you operate out of, you want to get a look at that lease, review it with your lawyer. Can you terminate that lease early? If you're able to terminate the lease early, are there penalties for early termination? What are your notice obligations for terminating early? Is it assignable? So can you assign your existing lease to a purchaser? If you're closing the business, you have no other options, what are your financial penalties for closing or terminating that lease early? These are really important obligations, and it's not just about your lease premises or the lease for the premises. It's all of your obligations. You might have financial lenders, you might have creditors that you have obligations to. There might be outstanding guarantees or security that's been provided to your creditors. You're going to look at all that stuff. Look at your expiry dates, and if you've got a contract that's coming due in the very near future, and maybe you're not ready to sell or close, consider getting a renewal of that contract on a very short-term basis, right? Or even a fluid basis. Maybe it becomes a month-to-month lease to give you flexibility, and you don't have to worry about discharge penalties or termination penalties as you go. So reviewing all of your contracts and all of your obligations early will help you plan for your sale as well as for your closing. And last but not least, you got to talk about your employees, right? And you have to do that early. What I would tell you is it's slightly different for a sale than maybe it is for a closure. But if you have employment contracts with your employees, you need to get those out and dust those off and get them reviewed by your lawyer. And I say that because there's been recent case law. I would probably tell you that employment contracts that were drafted really anything longer than about 5 years ago now, maybe even a little bit more recent than that. There's been a lot of case law that would suggest that the termination that was used in those contracts could potentially now be considered to be a violation of the Employment Standards Act. And if that's the case, then the employment contract that you carefully drafted and put in place as a diligent employer could now be considered null and void. So if your contract has a termination clause that provides for a certain entitlement for your employees at the time of their dismissal, there's a chance that that entire contract is declared null and void, and the obligations to your employees change dramatically. So get out your employment contracts, talk to your advisors about that, and discuss with your advisors a strategy as to how you can minimize the financial impact of severance pay obligations or separation package obligations with your employees. Certainly in the terms of a sale, I would encourage everybody to strongly consider requiring any buyer to continue the employment of all of your employees on terms that are no less favorable than they were at the time of the business sale, right? So whatever your employees were making at that time, whatever benefits they had in place, whatever length of service that they had, you require the buyer to assume all of those obligations, right? And that'll be a huge help for you if you're looking at selling the business in terms of minimizing your obligations. All right, I'm going to go as quickly as I can through the rest of this stuff because I'm starting to run out of time. But in terms of preparing the business for sale, the last and probably most important part of it is now you need a buyer, right? You can do all you want to get your business ready for sale, but you need a buyer. And I know Carol mentioned the CDC's BizLink program. I know that's been very successful. I've had at least one client now who's been able to sell their business through that program, and I'm working with a couple more who are in the process. It solves a lot of problems for a seller in terms of confidentiality and for buyers to be able to quickly sort and filter out any businesses that they might not be interested in. So the BizLink program is a good one if you don't have anybody lined up already. If you're looking at an intergenerational transfer, so maybe your kids are looking at buying the business, that's certainly an option. I think there's a lot of considerations there that you need to think about early on in the process, but that's certainly an option. Your employees are another opportunity. They know the business, they know the clients. There's a really good opportunity. So if you're selling the business to an employee, that they can retain the goodwill because they're involved and they know the client. So selling to a potential employee is a great idea. If you don't have any lined up, maybe you start grooming somebody who could potentially take over that business someday. It's a good option. And then certainly you can always use an agent or a broker who can help you find the right buyer if that's desirable. So in terms of preparing the business, that was a good bulk of my presentation, and I hope you understand why. Without that proper foundation, everything else becomes quite tenuous. So do your due diligence, make sure you've done a good job getting the business ready for sale, and then getting through the rest of it is pretty simple. So after you're done preparing the business, now it's about documenting the sale. And I can go through this fairly quickly. Not every time will you require a confidentiality and non-disclosure agreement, but before you start sharing information, sensitive information about your business, always a good idea to get a buyer on the bottom line, make sure that they're obligated to keep that information confidential. They're not allowed to disclose it. They have to return it to you or destroy it if for whatever reason the transaction doesn't get completed. And there should be provisions in there that say no public discussions about the potential sale happen at all without the mutual consent of the parties, right? The last thing you want is for your employees or your suppliers to hear about you potentially selling the business before it's time, before you're ready to talk to them about that. They need to hear about it from you. So that's certainly important. The next document really you'd be looking at is a letter of intent. Again, not every business requires it, but a letter of intent deals with all of your showstoppers, right? It's not a binding agreement, But it's exactly that. It's a letter of intent, and it's intended for the parties to be able to kind of set the ground rules. What is the purchase price going to be? Maybe it's subject to adjustments, but you have a good idea of the purchase price. How is it being paid? What kind of security is being provided for any payments that might occur post-closing? Certainly, when you get into a letter of intent, you have a good idea of whether you're selling the shares of your business or the assets. Not to get into too much detail on that again, but if you're selling the assets, it's kind of like, well, consider your corporation obviously is the only opportunity you'd have to sell shares, right? If you're incorporated. But to explain it as simply as I can, consider a pail of water, the pail being the corporation and the water being the assets within that corporation. An asset sale really suggests that you take your pail and a buyer comes along and you pour your water from your pail into their pail. So from your business vehicle to their business vehicle, they start fresh, right? They might have their own brand new shiny pail, right? I'm not sure if this is the greatest analogy or not, but I'm going to run with it. So their pail is fresh, it's new, there's no history, right? And that's an asset sale. So they take your water. They can choose to leave a little bit of water in your pail, right? They don't have to take all of your assets, but they will probably take substantially all of your assets. And the other option is a share sale, in which you're giving them your entire pail, right? Your pail might have scratches and dents in it. It has a history, right? Maybe not, maybe it's perfect. But if there's a history, then the buyer is inheriting that history along with it, right? They're taking your corporation as it exists. There may be some historical issues with the company that they have to be willing to accept. So that's the main difference between an asset sale and a share sale. People in the industry, if they heard me explain it that way, would probably cringe. But anyway, I think it conveys the point. So certainly when you get to the letter of intent stage, you need to have a good idea of how you're handling the sale, whether it's assets or shares, and you're dealing with all the showstopper issues. The other thing a letter of intent will include is things like how the due diligence process is going to happen, right? What kind of information is going to be shared, in what kind of time frame, and when will that period end, right? So at what deadline do the parties have to enter into a definitive agreement? Maybe it's 60 days out. The parties have to have a definitive agreement in place, otherwise the deal's off. For a seller, you may consider giving your buyer an exclusive period, right? So they have 30 or 60 days. Within that period of time, you agree not to solicit or entertain any other offers. So they have exclusive rights. They're going to invest a lot of time and effort in the due diligence process, and they would like that reassurance. So that can certainly be helpful. There are some elements in a letter of intent that would be binding. For example, confidentiality provisions, the exclusivity provision, for example. Generally, procedural issues would be considered binding. The showstopper type, financial type issues are generally guidelines that will help guide the drafting of a definitive agreement. And I've had lots of clients who say, you know what, I don't need a letter of intent. Let's just skip that and we'll go right into an agreement of purchase and sale. The agreement of purchase and sale is the penultimate document that covers everything regarding the sale. And there'll be lots of stuff in there, adjustments for prepaid expenses or gift cards, how you're dealing with your employees, certainly the manner of payment, the allocation of the purchase price. There's a whole bunch of stuff that goes into that agreement of purchase and sale. I'm not going to go through it in detail now. Your advisors can walk you through all of that stuff. And then the only other thing that I think you should make note of, again, in the purchase and sale agreement, is dealing with your employees. Hopefully there's a continuity of employment. And don't be surprised if it includes a non-competition or non-solicitation covenant, okay? If you're selling your business to a buyer, the last thing that they want is to have you open up a business across the street and compete with them. So while non-competition agreements are generally frowned upon in an employment context these days, they're certainly still quite binding in a commercial context where you're buying and selling a business, okay? So don't be surprised. Last part of selling the business is post-closing. You've got proceeds of sale, right? You got to deal with the proceeds of sale. They're either held by your corporation or they're held by you personally. Certainly, if you've been facing some financial pressures or some solvency issues, you're going to want to talk to Brenda and Robin, talk about priorities in terms of repaying creditors, if there's any creditors that have to be repaid, discharging obligations, all that good stuff. You might have some accounts that you have to close out, insurance, utilities, all that stuff, if they're not handled in the course of the sale. Do your final tax return for the corporation. or for your business. Obviously, you have to deal with your corporation. If you've sold the assets and you still retain the corporation, you're going to have to dissolve that, potentially amalgamate it with another corporation. That's largely a tax-driven issue, but you got to deal with the corporation. And then finally, on the sale, consider looking at your wills and powers of attorney, right? You might have had provisions in your wills and power of attorney that were specific to your business. Get them out, dust them off, have a look at them, revise them if required, right? Every life event that you go through, you should really consider updating your wills and powers of attorney. So I hope that wasn't too quick, but that was really everything related to selling a business. Really quickly, in terms of closing your business, again, congratulations if you did all the work already to get your business ready to sell, because you've already got a lot of the work done in terms of getting it ready to close. And I can go through this very quickly. So yes, gathering all the info like you did when you're getting your business ready to sell. Meet with your team early again. Certainly reviewing financial obligations and planning to deal with creditors might be more important if you didn't have an option to sell your business and now you're looking at no other option but to close your business. You may be facing financial pressures that require to look at that. Again, reviewing all of your contracts and obligations as we discussed previously. A lease obligation in this instance is probably quite important. You might not have a buyer who's willing to assume your existing lease. So dealing with your landlord in terms of terminating that lease or lining up your the closing of your business to align with the termination of your lease might be important. Planning for your employees is probably even more important in the context of a business closure. There are strategies to be able to minimize the financial impact of separation packages. Again, you want to talk about that very early with your lawyer. Working notice is something that can be provided. Working notice maybe with a retention bonus at the end. So you tell your employees as soon as possible that you have no choice but to close your business. It'll happen in 6 months from now. But if you stay with me right to the very end, there's a small retention bonus available for you. And maybe that's a way for you to be able to keep your employees till the end. There are strategies in place that you can use, okay? So again, deal with your employees, obviously, as soon as you can. Think about that. Having a communication plan is extremely important, both internal and external, so you can control that plan. Meet with your advisors again, so you can advise your suppliers, advise your employees, so that you stay in control of that process. It's important. Okay, your final tax return done. Again, deal with your corporation if it's applicable in terms of closing it. And then my last comment is wills and powers of attorney. Don't forget, get those up to date. So I know I went through that really, really quickly. I wanted to try to get done. I had 2:35, so I'm a little bit over, but hopefully that gave you guys a really good idea of what you need to consider from a legal standpoint in terms of closing your business or selling your business. There's my contact info. If you've got any questions, again, don't hesitate to send me a quick email or give me a phone call, and I'd be happy to answer your questions if we aren't able to get to them today. So with that, I heard Carol's comments at the beginning. She doesn't want to come back on here. So I think I can stop sharing my screen and hand this over to David, and I can learn a few things from his presentation. Thanks very much, everybody.
Okay, thank you very much, Tim. That was great. And I think you're going to find my presentation, hits on a lot of those same topics, just from a slightly different, the sort of accounting side. So I'm just going to work out my video sharing here. Screen share. Okay, so I have quite a few slides, and I'll go through these fairly quickly, but I think the slides will be made available to all people at the end. And so I'll be spending more time on the more important slides. Some are just there for reference. So what we're going to go through is just preparing yourself and your business for sale, sort of knowing your business's value, and I'll sort of go over just roughly some the general theory behind business valuation that really applies to all valuations, and just how you might look at that from a high level. Give you some tips to maximize value and some tax minimization strategies. So the first thing, as far as sorry, just making sure my technology is working here. So the first thing, as far as it goes to preparing your business, the question is always like, when is the right time to start thinking about selling your business? My answer to that is generally, it is when you start your business is when you should start thinking about selling your business. So obviously for many people that, you know, you might be a little bit behind the ball on that. So the time to start thinking about selling your business is now. You need to start thinking about who would be a potential buyer, all that stuff, because the process can take a while. You might need to do a number of things before selling your business that can take a bit of time, such as if you want to do certain tax minimization strategies. There are some restrictions on those that can take a couple of years to prepare to do. So, like I said, the time is now to start thinking about who would buy it, getting everything organized and in order and that sort of stuff to be able to make sure that that transition is successful. Okay, so then as far as when you're then thinking about selling your business, you know, what are the options there? What is most likely? The three major categories are sale to a family member, whether that be a brother, sister, or a succession to the next generation, as well your management employees. There's always a great thing to do is to hire the next purchase, or to hire your purchaser. Hire someone to come in, learn the business, and eventually transition it to them. Then there's the sale to third parties. Again, another great option, but you know, you have to find those parties. That's where the CDC BizLink and other people come into play to help you do that. And the other thing is to keep the options open. Don't get focused just on one option. At the end of the day, you have to be sort of fluid, because when you start going down this process, it doesn't always go as planned. So keep your options open and know that there's more way to proceed than one. As far as, you know, the key planning steps, another is understand the range of your business's worth. And so in doing that, you need to, it's key to understand, because you need to make sure that is that a value that you're happy with? If not, is there a way to improve it to get it to a value that you're happy with? Or is that just the reality that you then need to sort of deal with and work into your financial plans accordingly? Make sure you're consulting with your accountant and financial planner to make sure that after the business sale, that is going to meet your retirement needs, being that your savings, RSPs, plus the business sale, is that going to be enough to provide for your retirement? Or if you're just transitioning careers, is that going to be enough to bridge the gap between selling the business and the next career you're going to go to? Also consider what you want your life to look at post transition. This is part of preparing yourself for the business sale. As a business owner, you know, you dedicate your life in essence to your business. Many business owners are spending 50, 60 hours a week working on their business and in their business. And so sometimes the transition to retirement can be pretty abrupt. So you need to think about what your life looks like after that, to make sure you have hobbies, pastimes, whether it's a new career, that type of thing, to keep yourself busy. The other key thing is don't check out early. A big issue that I see quite a bit is that someone will approach me about sort of assistance in valuing the business, getting it ready for sale. And they come to me at, you know, what we'll call the 11th hour, and they have already mentally checked out of the business. And they say, you know, the last 5 years, it's just kind of been tired. I haven't been trying to get new customers at all. I've just kind of been servicing the ones I have, and that's slowly going down because I'm not making any marketing efforts. And then you now have a business that has potentially 5 years or 3 years of decreasing sales, which does not look great from a marketing standpoint. And even though you may say, well, it's because I'm not doing any advertising, I could go out and do the advertising and marketing and networking and all that stuff to make the business succeed. that's an uncertainty to the purchaser. You know, they can look at that and say, is that why it is, or have they been getting poor service, or is the product not great? That sort of stuff. So the key is don't check out early, especially if you feel yourself really hitting that point of exhaustion. Then it's definitely time to really think about selling that business, because there's many things that can occur in that process. You know, as long as you keep selling, keep your sales up, keep it being a healthy business, then you're going to maximize your proceeds. There's always options that post-sale, perhaps you stay on or on part-time, that sort of thing. So it can keep you busy, can provide some additional income in retirement, or it's that opportunity to go do something else where maybe you're not fully ready for retirement, but you can sell the business at its peak or when it's extremely healthy, and then move on to something that's maybe not as stressful or whatever as you sort of transition into retirement. Other things is make yourself redundant. The businesses that carry the most value and that have the way to get the greatest value is make the business run without yourself. I fully realize that's not possible for all businesses. There are many businesses that need the individuals there, but so much that you can. And if you do have a business where you do have the potential to hire a manager, general manager, operations manager, that sort of thing, the less dependent upon you the business is, the greater the value. Again, make sure you have clean financial records. So that's to Tim's point, you know, making sure you get all your financial, you know, be organized, get all your financials ready and in one spot, all your tax returns, organize all your documents, records, contracts. Again, as Tim said, seeing your advisors early, very important. Make sure that that Minutebook is up to date. You've had you know what contracts your business is in, being leases, anything from photocopiers, all that sort of stuff. So make sure you have those contracts ready and available. Another aspect is, you know, documenting key processes, procedures, methodologies. Again, this goes to the business is most valuable and best when operating without you. So if you can document all your processes, procedures, methodologies, then the person coming into the business, when they're looking at purchasing the business, it's like a franchise. That's why, you know, franchises make for excellent sort of first businesses for people, and that's why they succeed, is because they have gone and they've documented all the businesses, processes, procedures. That's what they're selling to the potential new franchisee is, here's how you run it, here's how everything's done. And it just gives the purchaser more comfort in paying the price they're going to pay, possibly increasing the value, because they see exactly how to run the business. And once they get the business, they know that, oh, I forget how to do that. They can reach into the folder or into the binder or on this computer to know, hey, this is how I deal with this issue or how I do this process, that sort of thing. Key aspect is being organized. You know, gather 5 years at least of financial statements, tax return, any leases, contracts. As Tim was mentioning, employment agreements and summaries of all employees with their wages and tenure, because that's going to become important down the road when you're transitioning those employees. And when you're in Tim's office, you'll need to know exactly, you know, how long they've been there, because then he can give you advice as to how that transition occurs and all the rest of it. Because there are times where a certain purchaser, and there's often clauses in contracts where they get to say, you know, we will review the employment roster, but perhaps you have an employee who's caused troubles or is not in the greatest standing, you know, like good due diligence, they'll go and review employee files. And they'll say, well, you know, we're going to buy the business, but we don't want employee A or employee B. And then you need to know what your exposure is and how much that's going to cost to deal with that problem before the sale. As well as sort of assembling any customer contracts and customer and supplier contracts are very key. If you do have contracts with your customers, you need to have those available and accessible at any time. Detailed asset listing, again, what are you selling? You need to know all those assets that you have. any prior lawsuits, if any. And again, ensuring all your advisors are aware. So this slide here, again, I'm not going to spend much time on this one. And it is just about here, those are the various valuation approaches. So you can kind of use that to refer to. I'm going to just sort of concentrate on the most common generally when you're selling a business, and that's sort of the income approach. And under the income approach, the two key areas are capitalized cash flow or capitalized earnings or a discounted cash flow. The one thing I mentioned about sort of all businesses are valued the same way. A business is always worth, any business is worth the present value of its future cash flows. And so whether even some businesses don't engender goodwill, you won't necessarily sell them for more than what the assets are worth. However, it's still the same methodology when you're trying to value the business. You are just looking at like, okay, what are the assets worth on the open market? What can I get for them? How long will it take to sell those assets? That type of thing. And any of the methodologies you may hear, because as you're selling a business, you may talk to other business owners or your other advisors who will say, well, I've heard about an EBITDA approach, percentage of revenue, this sort of thing. They're all meant to, at the end of the day, come to what is the present value of the future cash flows. They're just sort of wrapped up a different way. Okay, so when it comes to sort of an earnings approach to a value or to value your business, there's sort of three key inputs to that business valuation. It is A, what are the earnings of the business? And as Tim discussed, you need to normalize those earnings. And I think my next slide sort of talks about that a bit. But what is the business earning? What is the appropriate multiple? And then what balance sheet adjustments are necessary? So A, you got to get the handle on the earnings. What's the multiple? The multiple is a measure of the risk of those future cash flows or earnings occurring. So if you have a business that is making $100 and it's made and I'm just using a number for a pure example here, but if it was making $100 a year and every year it kind of goes up by 2%, that type of thing, that's a very steady business. It also lowers the risk because in that business, your risk of those future cash flows reoccurring is low because they've happened for 5 or 10 years in the past. Therefore, that's sort of a lower risk and the earnings multiple in general will go up, okay? Likewise, if you have a business where it could be highly cyclical, then the earnings could fluctuate dramatically. In general, that is a riskier business and will therefore attract a lower multiple. That also goes to growth. If a business is experiencing declining sales and declining earnings and cash flow, then that is a riskier business than one where the earnings are increasing. So again, it adjusts that way. And the sort of, if you think of it it's an inverse relationship. The less risky a business, the higher the multiple. The more risky a business, the lower the multiple. So if you have to use two extremes, if a business is very risky, earning $100,000 a year, you apply a 2 multiple for $200,000, you have a less risky business, you apply a higher multiple. If it was still if that other business earning $100,000 a year also, you get a 4 times multiple, you get $400,000. So there's that inverse relationship between risk and reward. As Tim was mentioning, key is know sort of what that true earnings or cash flows are of the business. So you have to put yourself in what is going to happen post acquisition. So what is that new owner going to realize? And so that's where you need to normalize things like, as Tim was mentioning, owner manager remuneration. You can have a business and the owner could be paid $1 or he could be paid $1 million. What you have to do is replace that with what is the market wage for that job or service. Normalize any amounts paid to non-arm's length people. So the most common one is a real estate holding company or real estate that's not going to be part of the transaction. you have to account for the fact, say if you you might have a 100-acre farm, or you might be on a farm, and you run your business off 5 acres on the side, but you don't pay any rent. You have to take into consideration that if that business is still going to continue to run there, you will want to get rent paid for use of that land, or that business is going to have to move somewhere else where they're going to pay rent. So you have to make sure you take into consideration those non-arm's length transactions, any significant one-time events need to be normalized. And so that is just things that are not expected to reoccur in the future. That could be revenue or an expense. Expense amounts are, say, you underwent a significant upgrade to your computer systems, or incurred one large one-time expense that's not going to reoccur. You have to adjust for that. And then discretionary amounts, so that is personal expenses. I would especially recommend anyone who's getting close or wants to sell their business to minimize or eliminate all personal expenses, because the more, you know, you can say if a spouse's vehicle or one of your children's vehicle is going through the company, you can always point that out to the purchaser and say, okay, here's what the business earned. You need to adjust for the fact that I paid for a family vacation and my son's car is on there and whatever. But the more adjustments to the financial results you have to make, the more suspect, essentially purchasers will view that as slightly more risky. So, so it's just something to be aware of. And again, especially as you come to trying to sell the business, the less noise in the financial statements there is, the easier it is for someone to understand, the easier it is for them to get their head around the business, its value, all that stuff. So just a little tip there. I think I'm butting up against time, so I'm going to be pretty quick here. As far as minimizing taxes on the sale of business, Tim was also mentioning the sale of assets versus shares. In general, purchasers prefer to buy assets because, as his analogy, and I like it, it was good, you get the new bucket and you don't have to worry about any prior history. You know, there's no holes in that bucket and it looks nice and it's fine. So that's why purchasers prefer to buy assets. They have reduced exposure to liability. They get a bit of a bump on the transfer over of the assets, which provides some future tax shield. Sellers prefer to sell shares because there's tax savings to the seller and they reduce their own exposure to liability. Because when you sell shares, you also sell all the history of that corporation. So it generally becomes a negotiation point. Some businesses are just too risky. Like if you're, say, an environmental cleanup business, probably not going to be able to sell your shares because there's just too much history and potential lawsuits to go on. Whereas other businesses that don't perhaps have that exposure, it is easier to sell the shares. And then it becomes a negotiation a lot of times because the buyer will want to negotiate a bit generally to pay less for shares because they know you're getting the money tax-free, or potentially a good chunk of it. On the tax-free side, there is a capital gains exemption on the sale of qualified small business corporation shares. It's an $883,000 lifetime exemption, so it's quite lucrative. There are certain things you need to meet to get access to that. That is being Canadian controlled. All the business, all the assets used, or substantially all of the fair market value used in active business and held for 24 months prior to sales. Certain exceptions to all that stuff. And just the one thing is sort of what Tim also mentioned, cleansing the business. So that means that if it's accumulated excess cash, you got to get that out of the business prior to sale. And so that's where planning in advance comes in handy, because if you have to do that all of a sudden, it raises your taxes. You could get hit with a big tax bill, just cleansing the company. So the farther in advance you can be planning, the better. Yeah, the benefits of that takes planning, and tax savings can be in excess of $230,000 per shareholder, so it is quite a bit. There are strategies in an asset sale, so if you get in a situation where you need to sell the assets, it's not always the worst thing. There is low tax rates in general on capital gains within a corporation, which then create a capital dividend account, which create money that can come out to the shareholder tax-free. So there are ways to minimize taxes on an asset sale. It's not a doom and gloom thing at all. You can then use the corporation like an RSP going forward in your retirement. A few tips here to maximize the value is make yourself redundant. Document your business processes so they're easily understood. Keep selling. Hire your purchaser is always a great, as I said, a great way to transition small and mid-sized businesses. And then keep part of the risk. Generally, in a lot of small business sales, the purchaser or the vendor, the seller, has to keep a portion of the sale price, and you will maximize your sale price by doing so. So you take on risk because you do have the risk that you won't collect that in theory if the business doesn't succeed. But if you are confident in your business, you have a good business that you want to maximize your price, you need to take some of that back in a vendor take back because it shows you're confident that the business will continue doing what it's doing and therefore be able to pay that back. It's also where lawyers and Tim will come in handy to make sure your risks are minimized on that vendor take back because there's a lot of legal ins and outs to make sure you're secure to some degree. And other things, keep investing in your business right up to the time of sale. Again, don't let it just sort of start to fizzle away. You know, keep selling, keep active, keep employees engaged. Human resource capital is extremely valuable. Your employees, when someone can take over and they know they might have 2 or 3 or 20 or 100 employees that know what they're doing, do it well, and make that business a success, it's important to keep them engaged and around. One of the most often things I hear about people when selling a business is, when valuing a business, is that good people are hard to find. So if you're selling a business with good people, keep them engaged, keep them around, make sure they transition. Identify efficiencies in advance so you can maximize profits, and contract business increases value. So if you do have clients that are that are contractually obligated to purchase products or services from you, that increases the sale value. And then just a few final notes as I'm running / probably overtime. Be organized. Do know that business value is subjective. So you need to be analytical, not emotional in selling a business. It's not personal. And that will help when you have a realistic view of what the business is worth going into it. And then just a final point, that sales during the COVID pandemic, they are still happening, all the rest. So, okay, that's it. So I will now pass it on to Brenda and Robin. Once I figure out how to use this program.
Okay, Robin, I think you're on.
Okay, so great information already from both Tim and David. Brenda and I are here to talk about businesses that are having financial difficulties and options other than selling or winding down. So we're just going to talk a little about COVID. In the beginning, it felt temporary and not so much anymore. WSIB and Canada Revenue Agency were not aggressively pursuing outstanding balances. Banks initially were cooperative and reluctant to take action against any troubled accounts. Bold measures taken by various levels of government resulted in programs which helped many businesses ease cash flow pressure despite suffering a substantial loss in revenue. As reported recently by the Bank of Canada, nearly 1 in 3 businesses registered a revenue decrease of 30% or more in 2020 relative to 2019. Record low interest rates have also helped businesses manage cash flow challenges by reducing the amount of cash required to make interest payments. The result is that a lot of businesses are carrying more debt now than they have historically. As the government programs run their course, it's expected that a number of businesses will no longer be financially viable without the government programs. The hardship caused by the COVID pandemic is not shared equally depending on the industry, geographical area, and effects of the government-imposed closures and sanctions. Small businesses and firms in high contact service industries have been most harshly affected. Home renovation companies, direct delivery services such as Amazon and logistics related companies have done very well. Different parts of the economy are rallying at different rates. This is referred to as a K-shaped economic recovery. It's good for some and not good for others. Who would have thought that a drive-through window would increase the value of a business?
So what we've learned is that 1 in 10 businesses adopted during this pandemic or incorporated digital technology to move business operations or sales online. As COVID restrictions were put in place, many businesses were forced to seek external financing in order to survive. As a result, some businesses have now reached a point where they don't have the ability to take on more debt, and some have reached a point where their current debt is no longer even manageable. We know the COVID-19 pandemic has changed consumer behavior, attitude towards office work, and even some views about society itself. What small business owners must realize is that the financial struggles of your businesses today are very likely a result of the COVID closures. Many of you are victims here. You do not need to suffer through these difficult times on your own. Struggling with financial debt can be an isolating and lonely place to be. Please know that you are not alone, and we would be pleased to come alongside and share in the pressure of this difficult situation.
Your business may have had challenges prior to COVID, and COVID exacerbated the situation. Often as humans, we're in denial. This is a natural reaction to the stress. Part of the human condition is that problems can be addressed and resolved. Entrepreneurs are naturally optimistic, take charge individuals. By nature, they try to make the best of things. The financial failure of their business can leave them feeling uncharacteristically helpless and overwhelmed. Failure is a risk of all businesses. In today's economy, many well-run, successful businesses are vulnerable for insolvency. Many successful businesses have had prior business failures and still to go on to become president of the United States. And we're not just talking Donald Trump. Once in trouble, there may be a social stigma, especially in a small community or a small industry. Some folks suffer emotional paralysis, unable to make decisions, so unable to extricate themselves from the situation. Don't let uncertainty get in the way of decision-making, causing you to seek help too late. In addition, the stress of a business owner is higher than an employee. And if the stress becomes chronic, then there are elevated risks of significant health changes, both physical and mental. Often it is an external party that forces the issue, like a lender, a supplier, or CRA. You need to make rational, logical, objective decisions to provide the best opportunity to get out of the situation. To reiterate what both Tim and David have said, seek professional help early. That will help you remain in control of the situation.
I've just missed a slide. There we go. Right there. Sometimes in dealing with financial difficulties, wouldn't it be fun to just pick up the phone and say, Sarah, have sales do that thing where profits go up? Slightly unrealistic though. What we're going to do is look at informal options. Informal, maybe I'll just say formal options would be an insolvency proceeding under legislation. An informal option is where from your kitchen table or from your lawyer's office, you simply come up with some ideas as to how to negotiate with your creditors. So number one, you could always consider an injection of cash. You could arrange a compromise of your debt with the creditors. That's where you say, look, I can pay you in full over time, or maybe I can only pay you this much What do you think? You could close the door and walk away, or you could sell the business, as Tim and David have spoken of already, or even sell a division of the business. The benefits in doing an informal proposal is that it's discreet and quick. There's no court involvement. There's limited publicity and the impact on goodwill, and of course, limited professional fees. There's no requirement for the majority of creditors to approve. So for example, if you had one big supplier, just negotiating with him may solve the problem. If you have one or two, if you have several creditors, sometimes it's hard to get all of them on the same page. And if you don't, have you really been successful in your plan, or is it just a Band-Aid? The disadvantages are if there are two or more creditors, that's one of the disadvantages. An informal proposal may have significant professional fees if the creditors are not in agreement, and instead to choose to initiate legal action and recover funds.
Okay, formal options. This is predominantly more on corporations, but if you are a sole proprietor, the debts and assets of your company belong to you. So should you choose to go through a formal restructuring to deal with the financial challenges your business faces, you'll also need to include your personal assets and your personal debts at the same time. A corporation is a separate legal entity. So a formal restructuring option would be a separate procedure involving only the business. Formal options, one is a proposal, which will allow you to continue to operate your business and provide some relief from the financial burden. A proposal is basically a deal with your creditors. You may pay them 100% of what they're owed over time, or compromise, meaning reduce the amount they're owed. The main rule is that they need to receive more in a proposal than they would if your business were to file for bankruptcy. The proposal must be realistic. The creditors ultimately decide whether or not to accept the proposal. If they choose not to accept it, then the business is deemed bankrupt. Another option is a forbearance agreement. This is when a company is in breach of its covenants with its lenders. Its lender may require the company to sign a forbearance agreement. The lender will require that the company agree to certain conditions and allow a specified time period for meeting those conditions. In exchange, the lender agrees to not take enforcement measures, such as appointing a receiver to shut down the company and sell the assets. The forbearance agreement would allow the company to continue to operate and provide some breathing room. Another option is a receiver. A receiver is a trustee in bankruptcy appointed to take possession of the property of a company pursuant to a security agreement, either a private appointment or through a court order. The receiver looks to realize on the assets. Bankruptcy is when the company no longer operates. It shuts down a business. As soon as you sign the bankruptcy paperwork, operations stop. Your employees and your creditors are informed that your company's filed for bankruptcy. To pay your creditors, the trustee will work with you to realize on your business assets, if any. This may include selling equipment, trademarks, completing work in process, and collecting the accounts receivable. While the trustee is in charge of this effort, it's not unusual for business owners and former staff to take an active role in collecting the outstanding payments from the business customers. The owner and former staff will have better insight into the circumstances of the money owed by the customer. Some owners help the trustee realize on assets because the owner is personally guaranteed the loan or line of credit and want to ensure that all efforts are made to realize on the assets so the owner is not personally liable, or to at least reduce the amount of the personal liability. The last option is a CCAA, Companies Creditor Arrangement Act. This is a court-driven process that will allow an insolvent company to restructure and avoid bankruptcy. Debts must exceed $5 million. This is generally used for very large companies such as Air Canada, Stelco. It's a very expensive process because every step of it is governed by the courts. So a number of lawyers are involved.
For the sake of time, I'll quickly go through directors' personal liabilities. It was interesting, someone posted a question already about why is there director's liability for government debt? And that's pursuant to legislation. It is what it is. So hopefully when your lawyer or accountant helped you to set up a corporation, they alerted you to the fact that you want to make sure you look after the government. So director's liability, payroll taxes, HST, wages and vacation pay, credit card debt, personal guarantees, environmental liability, construction lien act, which would involve possibly a conversion of trust funds. And please note that these are illustrative. And you need to certainly get some legal advice on that.
For successful restructuring, you need to be realistic. Heed the warning signals, act constructively, and seek professional help early, as we mentioned earlier. Avoid the denial and delay stages of insolvency, benefit from the limited window of opportunity, do not waste resources on piecemeal solutions. In order to notice the warning signs, you need to know what your break-even point is, when your total cost and total revenue are equal. Know what it costs to do what you do, know your fixed cost, and be aware of your variable costs and changes that affect both. Examples may be an increase in the price of plywood, hydro, gas, changes in currency fluctuations. Intel on suppliers and customers is critical. If your main customer is pursuing a large account or relocating out of the country, how will this affect your volume of orders? Reasonably priced software is available to assist you to track, analyze, and display key performance indicators, metrics, and key data points to monitor the health of your business. Bank balances, accounts receivable number of days outstanding, accounts payable number of days outstanding, orders in the pipeline, order backlog. These software programs allow this information at your fingertips.
So just to wrap things up, the Bankruptcy and Insolvency Act is a federal statute that was passed a long time ago to provide the honest but an unfortunate debtor an opportunity for a fresh new start, whether that be a living, breathing human being, proprietorship, or a corporation. Because of the complexity of this legislation and the way it interacts with other statutes, the government insisted that only a licensed insolvency trustee administer the provisions of this act. Farber and Partners, Inc. is a licensed insolvency trustee, as are Robin and I. In the event you reach out to your accountant or lawyer about insolvency matters, they should refer you to a licensed insolvency trustee, as only we can administer the provisions of this legislation. Suffice it to say, with the number of folks on this webinar, clearly everyone has a different story, which is why we offer free confidential consultations. To try to do a blanket explanation for every possible scenario is almost impossible. So when you contact a trustee, our initial goal is to review your specific situation, explore the various options available, and to discuss the consequences of each of those options, so that after the consult, you're in a much better position to make a properly informed decision as to how best to deal with your creditors. Robin and I and the rest of our Farber team feel that we've had a successful day when we're able to assist you with an option outside of this legislation. But if you need the protection of this statute, we are pleased to support you through the government regulated programs. Information provided during our call is held in confidence, and we make recommendations only. And that wraps us up. And I think Wendy was going to open the floor to discussion.
Actually, I am going to do that. So we do have a little bit of time for Q&A. We may go a little bit over 3:30. Please, if you have other obligations, feel free to send your questions separately, and we will try to respond to them as best we can. I'm just looking at the list of questions that I have here. one question here is, how would you stay in control after selling and being asked to stay on and help move things forward, like a 3-year contract? Do you want to take that one, Tim?
Yeah, sure. Wasn't sure. I think we all probably are in a position to be able to answer some of these questions. So maybe Carol, let us know who you think maybe is best served to answer, and then I can jump in if somebody else answers a question. If I have anything to add, maybe. If you're selling your business, it's not uncommon, right, for a buyer to want the seller to stick around, right? You know, they have contacts, they got you know, their clients, obviously, they are in touch with their suppliers, all that stuff. So to have them stick around after closing is often a good thing for the buyer as well as for the seller, right? Seller sometimes needs ongoing income. Potentially they want to stick around for a period of time, and there's different ways of doing that. So the most common thing, I guess, that I see is the signing of either an employment contract or a consultant agreement that sets out under the circumstances under which the seller would stick around, right? So it's an employment contract. There might be some other provisions in there that are a little bit unique in terms of you know, dismissals without cause, for example. But you know, you enter into a contract and you stick around and you provide the services that you're committed to provide, and they pay for them. There are ways to structure the sale so that the compensation can be taken a little bit differently. But for the most part, you know, that's really the simplest mechanism for somebody to stick around post closing. It's not easier. It's not really easy, honestly, for somebody selling to stick around and see somebody else running their business. So that might not be a long process, but it's something to keep in mind. I think that was the question, right, Carol? Was what might be the mechanism for them to stick around post closing?
As I understand it, yes, I think you've answered the question. So if there's any further follow-up to that, if the person who posed that question wants to put it in the chat, we can take a look at it. Could somebody speak about staff obligations if shutting down during COVID? That might be you again, Tim.
Might be back to me. I'll make my comments, and then certainly Brenda or Rob and David, if you have anything else to throw in there, jump in. Yeah, crazy times. The last year and a bit has been nuts, and it changes every day, right? And so today it's May the 20th. You know, I'll give you the best answer I can today. Maybe it's different tomorrow, right? It's crazy. But for employees who have been on a layoff, you know, the government introduced legislation to say, well, if they've been placed on a temporary layoff, we're going to deem them to be on infectious disease emergency leave. So those timeframes respective of temporary layoffs, many people are aware of, you know, if you've been off for 13 weeks within any 20-week period, you're deemed to have been terminated. Or if your employer is continuing your benefits, they can keep you on a temporary layoff for up to 35 weeks in a 52-week period. Well, it became pretty clear early on that that was going to be a problem for people to be deemed to be terminated. So the government put in place the infectious disease emergency leave. So you're not actually on a layoff any longer. If you're an employee who was put on a layoff, you're now on this emergency leave. So it's job protected leave. You're deemed to be on it if the employer had put you on a layoff. But once I think it's July 2nd might be the end of that period. But it's still available for an employee to choose to be on infectious disease emergency leave, right? So if they have to take care of a loved one, if they're sick themselves, it's job protected leave for those employees. So there's a whole bunch of different facets to this question, but for employees who have been off, if they didn't raise any objection such that they've accepted the layoff, and there's no issues about a constructive dismissal, even if it wasn't permitted under their employment contract. So they're off work. There's a whole bunch of questions now that have to be dealt with about bringing employees back, right? Have they been working remotely? Can I require them to come back to the office now? You know, do they have to get a vaccination before they can come back? Can I do mandatory testing in the office? Far beyond the scope of this discussion, but lots of issues for employers to be dealing with in terms of employees who have been off and potentially coming back. I think those are my comments. If anybody else has anything else to throw in there.
Anything else to add? Okay, that question actually came up quite a few times in different variations. And so, I mean, it's great to hear that and it's not surprising that employers are very interested in the well-being of their employees. They want to keep them on, they want to be able to bring them back, and there are ways that they can do that. So that's great, thank you. I think this one's probably for Brenda and Robin. It says, if I file a proposal or bankruptcy, can I include the amount I owe for my personal income tax?
Yes.
That was easy.
Yeah. So obviously we're talking about a human being or a proprietor, a sole proprietor. And that's why the question is about personal income tax. So yes, government can be compromised just like everybody else.
And I'll keep it with you because there's a sort of a follow-up question here. Interested in options, which I think we've offered actually, but I'm going to pose the question anyway, for dealing with financial distress. We started this business 2 months before COVID, so we were required to temporarily close. So I think there were probably a number of businesses very optimistic, started it, and then COVID hit. And
I guess what's the question? They started before COVID, and
I guess maybe just a reiteration of some of the options that are available to them.
it would come down to how much are they personally obligated for? I mean, if they haven't guaranteed any of the debts of the business personally, or if they all the debts are just with the business, they could just wind it down or shut it down. But it depends what debts the business owes. They only operated for 2 months, but they may have incurred quite a bit of personal funds just to start it up.
Mm-hmm.
They may owe tax, depending if it was a revenue generating business right within 2 months, and there's HST and they had employees and their payroll tax, they're personally liable for that. So unfortunately, we don't have a quick, easy answer. As Brenda said, every situation is a little different. So we need to probably have a one-on-one discussion to get a better sense of what the situation is.
I just want to quickly indicate here that a lot of people are afraid or uneasy about contacting a trustee because of the nature of the business that we're in. But please let that go. If you're struggling at all, you were open for a couple of months and then shut down, you have some very unique issues going on. The only way that Robin and I and our team can address those is if we understand each individual situation. And remember, as I said during the presentation, our goal is simply to explore options, discuss the consequences of the various options so that you're in a much better position to make an informed decision after the consultation. So don't be afraid to call. We will, the CDC will have our contact information and they'll be sending that out. Thanks.
That's great, thank you. So basically talk to a professional. Don't be afraid to talk about the situation is what we're saying, right?
Right.
Keep it to yourself. So here's a question. It says, I incorporated my company to keep my personal assets separate from my company. Why is CRA telling me I personally owe the HST and payroll tax owned by my company? Is that a David or?
I think I can address it, or unless David wants to address it.
Oh, go ahead.
Go ahead, okay. So when you incorporate a business, it is a separate legal entity, and that is the goal, to isolate your personal assets from the company debt. But the money owed to CRA, the company didn't generate that revenue. You collected HST on behalf of the government, and the payroll tax that is owed, you deducted it or had your payroll service deduct it from your employees' paychecks on behalf of the government. So it's really deemed to have an implied trust because you collected it on behalf of CRA. Does that answer that?
Yeah.
Yeah, and I'll just say there's no director's liability for corporate tax. So if your corporation has been running profitably and you owe some corporate tax, there's no director's liability for that. It's the deemed trust element, which is the payroll withholdings and HST.
Great. I have one that I think is for David here, and it's how will business valuations be affected by COVID?
There's sort of two aspects to that. It's so, and that is generally with COVID, all governments worldwide have decreased interest rates, and there's been a lot of liquidity or cash injected into the system by way of government supports. So that has generally increased business values. So if you hear about the S&P 500 or the stock market reaching all-time highs, like after there was the COVID dump, it spiked down and then it went right back up. And this sort of goes to the K-shaped recovery. So some businesses not doing so well, but a lot have done very well. And that's sort of been, so that aspect, more money, lower interest rates equals more value. The other aspect of that is that a lot of business, there's depends which side of the K you're on. At the end of the day, some businesses have done very well. I kind of look at it, there's kind of, if I have 10 business clients that come in, 6 or 7 are actually doing better than they were doing pre-COVID. 2 or 3 are doing the same, and maybe 1 or 2 are doing worse. I happen to own another business with my wife that's doing worse. So we were a business that was negatively impacted, and that would definitely decrease the value of that business. It's a indoor gymnastics club, so our business is built on people getting together inside. So not doing so well, but the government supports are sort of getting us through that period, but it would not be the time to sell that business at the end of the day.
Okay. See, we have another one here says, if you do file a proposal or bankruptcy, how does this affect my spouse? I'm not sure.
So I suppose we're really talking about a person as opposed to a corporation. So as an individual or sole proprietor, your credit rating will go down from an R1, which is perfect, to an R7 when you make a proposal for 3 years from the date of completion. It does not have a direct impact on your spouse. But what I will say is if you and your spouse own a house today and you make a proposal, everything's good, you've compromised your debt, your credit rating's gone down to an R7, 3 years from now, you and your wife decide to sell your house and you're moving into another one, you're going to need mortgage financing. The fact that you have made a consumer proposal may have a negative impact on obtaining the financing for the new house. You may hear the bank say something like, well, you've made a proposal, Frank, so we're going to have Mary see if she can qualify for the mortgage on her own. So it's sort of that backdoor indirect impact that it would have. You're on mute, Carol.
Thank you. I'm just going to quickly scroll down the questions that we have and just make sure that we're not missing something. There were some duplications, so let me just see here. Oh, how does the payment when a business sells, how is that typically handled? What's the process once you've sold the business for the money actually exchanging hands?
I'll comment a bit, and maybe Tim, you can chime in just from the legal closing aspect. My sort of input to that would just be depending on what you've agreed to as compensation, whether it's all cash or if it's a combination of cash and VTB, that sort of thing. So, but otherwise, generally it will flow through Tim, the lawyer, and the trust accounts and that sort of stuff. So I'll maybe let Tim chime in there.
Yeah, that's exactly right, David. So typically what happens, well, in many cases, there is some existing financing or other obligations that have to be discharged. And so what happens is you strike the agreement, both parties will direct that the money flows through their respective lawyers' offices. And before we can distribute proceeds to the client, there's often conditions there that requires us to discharge other creditors, right? Repay creditors and discharge loans. We provide our undertaking to do that before distributing proceeds to the client. So So that's basically the process, goes through the lawyer's offices, and then there's a great big pot of cash for the client, and we ask them how they want it. Do they want it by direct deposit or by check? I don't think we've ever actually paid it out in cash. I don't think that's a possibility, but maybe Bitcoin. I'm not sure where that's going. But,
Get the wheelbarrow out.
Okay, I think we've pretty much got through the questions that we've received, sort of eliminating the duplicates. I think some of them were handled during the course of the presentation. There's a question here about, are there any capital gain exemptions? I think that was covered.
Yeah, just in short, it's on shares and there's certain restrictions that you,
Okay.
and hence the planning in advance to make sure you can meet those. And you can transfer personal assets into a corporation prior to a sale to then meet that and get that capital gains exemption. But again, planning and talking to professional team beforehand.
Okay. So I think we're going to wrap it up so we don't keep everybody later than they need to be here. And I think we have handled most of the questions, but as I said, if you have something that you didn't think was covered, please feel free to forward it to us. I want to thank everybody for attending. A couple of things to note before we close the session. We're going to have a survey sent out by email along with a recording of the session. So again, if there's something that you didn't take notes on or you missed, you'll certainly be able to take another look at it. We are interested in knowing what you think, so please answer the survey if you can. Take a few moments to do that. We do take your feedback into consideration. If you're interested in hearing from more experts, information about the series can be found at simcoe.ca/ask-an-expert. Don't forget to register for the 2021 Simcoe County Virtual Job Fair, which is June 2nd from 10 a.m. to 2 p.m. Contact the CDC or the CFDC in your area, which includes Nottawasaga Community Futures, North Simcoe Community Development Corporation, and the South Georgian Bay Center for Business. This is a regional BizLink program, and it's supported through an Ontario Trillium Foundation Grow Grant. So it truly is offered regionally amongst all of our partners. So whoever happens to cover your geographic area, just be in touch and we can help you to learn more. Again, thank you to David, Brenda, and Tim and Robin for their time and their insights today. Thank you to all the partners who have been involved in helping us to present this. And everybody have a great rest of the week and a fantastic long weekend. Take care and stay safe.